Hello, my name is Denise Delaney, CFP, Senior Vice President and Wealth Advisor at Index Fund Advisors. And I'm thrilled to have Lauren Doyle here with us today, who's a partner at TLD Law right here in Irvine, and we're going to talk about federal estate taxes. Welcome, Lauren.
Thank you.
Yeah, I'm so happy you're here.
Yeah.
So can you tell us a little bit about yourself and your practice area?
Yeah, absolutely. So I am a second generation estate and business planning attorney with TLD Law, or Tredway Lumsdaine Doyle, where my practice is focused on helping my clients save money on taxes, stay out of court, and maintain family dynamics.
Well, those all sound like really good things.
Yeah.
That's fantastic. Well, as I mentioned, today we're going to talk about current rules regarding federal estate taxes. So first, let's look at the current thresholds and exemptions, and then we will look at when these are set to expire or sunset at the end of 2025. Can you please tell us more about the limits that are currently in place?
Yes, as an estate planning attorney, I get asked this all the time. You know, what is the estate tax? It's sometimes referred to as the death tax or the inheritance tax. But it's a tax that takes effect when a person passes away or makes lifetime gifts in excess of the exemption that is in place. And that exemption changes every year. This year, it's the highest it's ever been. It's 13.6 for an individual and 27.2 million for a married couple.
Wow.
Yes, so they are extremely high. That means if you pass away or make gifts during your lifetime that do not exceed that, then you will not be subject to that tax, which means most of the clients that I'm meeting with in this high exemption climate are not being impacted by this tax. But I do tell people the exemption changes every year, and there's no guarantee as to what it can be in the future. For example, just in the year 2000, it was $600,000. So if you passed away with that much money, you owed a tax for everything on top of that. And the tax is a graduated rate, but typically what I see is 40%. So that means you have to write a check to the IRS for 40% of the amount that is in excess of that upon a person's passing.
So we'd like to just give you the history of what the estate tax limits have been, and we'll show you all the way back to 2000. That being said, can you review for us these thresholds, when they're set to expire, and what are the proposed new thresholds?
Yes, absolutely. So this year, the exemption is as high as it's ever been, and next year it will be even higher. However, they are set to sunset at the end of 2025. So that means that if Congress does not renew the exemption amounts, that they will drop back down to pre-2027 rates, adjusted slightly for inflation, which we anticipate, no guarantee, to be about $7 million for an individual or $14 million for a married couple.
Very interesting.
Yeah.
Okay, so that's good to know. How do high net worth clients maximize or utilize the exemption levels?
So in this high exemption climate, what I'm seeing for our high net worth individuals is they are primarily using lifetime gifting. So when we talk about the estate tax, it goes hand in hand with the gift tax, meaning something that you gift during your lifetime, that is counted towards that lifetime exclusion that you get, that lifetime exemption that you get. So we have clients saying, all right, this is the highest the exemption's ever been. Let's fully push out the full exemption amount. So we do have clients that gift out $27 million in this year, or they're anticipating a larger gift next year to fully get it out of their estate. So that's how I see high net worth individuals using that. But there's also what's called your annual exclusion, and that is the amount that you can give away in any year to as many people as you'd like, and there's no reporting required for that. So this year, it's $18,000, so you can give away $18,000 to as many people as you'd like, and you don't have to let the IRS know about that. It doesn't count towards your larger exemption. So it's a way to reduce your estate without utilizing
So for example, if you have a married couple, each person could gift $18,000 to as many people as they wished.
Correct. And I do see a lot of families where mom and dad will gift to all of their children, then they'll give to the children's spouses, and they'll give to all the grandchildren. So $36,000 to each of these individuals. It's a great tool to use if you are somebody that's looking to reduce your estate
Seems
tax
like
liability.
a very prudent way to handle things during the lifetime, do some good while mom and dad are still around, or grandparents
Exactly.
even.
Yeah.
Okay, so what are the ways people can use that $18,000 annual exclusion?
Yeah, so I see it used different ways. So for one is somebody that's concerned about the estate tax exemption, they might set up what's called an irrevocable life insurance trust. And what that is you take out a life insurance policy, and the policy premiums, they're actually using that $18,000 to pay the policy premiums. And then when they pass away, they have this policy that is paid out to the children. It's not includable in the estate, and then the funds from that are actually used to pay a potential estate tax liability. So that's one way I see it
That's
used.
very interesting technique. So how are the lifetime gifts treated for estate tax purposes at death?
Yes, so the way that the estate tax works is when you pass away, you have 6 months to file an estate tax return.
Okay.
And what that means is we have to value everything that you owned at your death. And so oftentimes it takes longer than 6 months to do that. You can get an extension, and we oftentimes do, but you'll need to value all your business interests, all your real estate. We add that all up and we say, are you going to hit that exemption? But we also have to look at prior gifting that you made during your lifetime. What it doesn't include is the annual exclusion. So that $18,000 that you got out to all those people doesn't count towards that. But if you ever exceeded the $18,000 to any one individual, you would have had to have filed a gift tax return during your lifetime. And while you didn't owe a tax on it, because you didn't hit that large exemption amount, it does count towards that exemption. So we count both your lifetime gifts and what you own at your passing to determine whether an estate tax is due.
So I wanted to know a little bit more without getting too far into the weeds for the topic of this presentation. We can always do a sequel. What are some other strategies for taking advantage of the larger exemption?
Yeah.
If a family decides to do gifting, can they maintain control for how the funds are used?
Yeah, that's a great question. So some of our high net worth individuals, ultra high net worth individuals, what they're doing is they're not just making a gift outright to an individual to say, you know, here, I make this $1 million gift to my child and do with it what you want. No. They want to maintain some sort of control over that. So what they do is they set up an irrevocable trust. It is a trust they set up during their lifetime. It's different from your typical revocable trust that avoids probate. This is specifically for gifting. And so they'll set up this, it's called a grantor trust or a non-grantor trust. You can structure it either way. But it has a trustee on it. And that trustee, it cannot be the grantor, can't be the parent. But usually we'll see it be a professional or somebody like that. And they manage those funds for the benefit of the children and the grandchildren. And that way, mom and dad still have input on how those funds are used while it being completely out of their estate. And an extra little benefit there is if you make it a non-grantor trust, that means that the grantor is actually still responsible for the taxes that are paid on that trust each year. So it's another way to reduce their estate and allowing the assets in that irrevocable trust to grow. Another great benefit of these types of trusts is their generation skipping. So if you have a high net worth client that also has children that are going to be high net worth as well, the funds that are put into that irrevocable trust, if structured the right way, actually stay out of the estate of the child. So that child, you know, isn't worried about when they pass away, will there be an estate tax due? It flows down to the next generation.
So interesting, and just thinking ahead a little bit, and from my own experience as a wealth advisor here at Index Fund Advisors, that trust, those trust assets, since they're earmarked for the heirs, could technically be managed possibly at a higher risk level because it'll be longer before they use those assets.
Absolutely.
So it may be that they have a portfolio risk level in their household that we're managing that may be more middle of the road, but then those assets could be segregated and managed separately.
Yes, and that's why it's so important to talk with your financial advisor, somebody like you, Denise, about when we're deciding to do this gifting, which assets are appropriate for that. There are tax consideration, but there's also those types of considerations.
There's so many factors that go into the blender, if you will.
Absolutely.
Yes, yes. Well, our scope today has been to really discuss the federal estate taxes and then the gift taxes and how they interact with one another and give some general information about that. But there are other tax considerations such as capital gains taxes, which you can do some tax planning around that with regard to, you know, current lifestyle versus, again, if you wait until the spouse dies and then create additional trusts. Explain maybe just a little bit about how that works when you have during the married couple's lifetime, how they establish a revocable trust and maybe how they plan around that. And then also here in California, there's some property tax planning that can be done. I mean, there's just numerous ways to approach this, which is why we need someone like you working in tandem with someone like me. So maybe you can just hit on that just a little bit.
Yes, absolutely. So, you know, we're here to talk about the estate tax. It's a federal tax. It applies in every state. But there are many other considerations when we're doing this type of work. Like you said, capital gains tax. And here in California, we have property taxes that are very impactful to our homeowners. So we need to balance all of these things as we're making these decisions. And that's why it's so important to work with a team of people that can give you that holistic approach. When it comes to capital gains taxes, so when you gift an asset during your lifetime to somebody, like let's say you created one of these irrevocable trusts and you gift an asset into it, the child's gonna get the same basis as the grantor has in that asset, which means if they turn around and sell that asset, there's going to be a larger capital gains tax impact because your capital gains taxes are based on what you sell it for and what the basis is. So if your parent, let's say, for example, has some real estate that they've held for a long time and they gift it, their basis is going to be very low. And when the property is sold in the future, that's going to be a large difference there that's taxed. Alternatively, if you give property to people on death, so when property or assets pass on death, you get what's called a step up in basis, meaning the basis for that goes up to the fair market value. So if the intention is then to sell it, there will be no tax at the time of death and when you sell it. So it's important to think about when we're planning and to do it, plan in a time when we're all healthy and in good relations with our family about what is the intention with this asset. Do we intend to hold this for a long period of time in our family? Or is the intention if mom and dad pass, we're going to be selling this? So that's a factor. Then with property taxes, which applies here in California on our real estate, if you're going to be gifting or passing away and inheriting property, your property taxes are going to get reassessed, meaning they're going to go up unless certain strategies are put into place during lifetime. So those are the types of conversations I have with people. We look out for, what are these assets? What is our goal with these assets? And I think of it as generational wealth planning, meaning, a lot of people here in Southern California have their wealth from multiple generations of owning businesses and real estate, and they want that legacy to continue on for the next generation. So it's so important to have these conversations with somebody like you, and then to implement them with legal strategies and tax.
And as you said, this issue covers a whole range of net worth, right? So one of the things that I see are when you have a married couple during their life establishing a trust that then has a portion that becomes irrevocable at death, or also called a bypass trust. And I personally have many clients that have those bypass trusts where they're able to take an income stream. And I don't know that everyone is familiar with that technique, so that's also something to think about. Again, there's just so many different ways to approach this, and it's very personal.
Right.
As you and I both know, we work very closely with people and learn about their families and get to know them and make suggestions that we think might be very helpful in their very specific situations. I may do it with financial planning. We have IFA taxes, so we offer tax preparation for our clients also. So we really appreciate having someone like you as a resource for our clients that need some help to get guidance on how to establish their estate plan. It's so important.
Yeah, and I'll speak to that. Other things that individuals that maybe aren't considered high net worth, aren't getting close to that 13 million or 27 million, there are things that you can be doing during your lifetime, and one of those is setting up your own just revocable trust. It has multiple benefits. The big one that most people talk about is it avoids going to probate court.
Yes.
But there are tax advantages, as you said. So you can structure a trust, and I do advise people to set it up this way for a married couple, that when one person passes away, the trust splits into two trusts, one for the survivor and the bypass trust, which is for the decedent. Now that bypass trust can be funded up to the full exemption amount in the year of that person's passing.
Amazing.
And those assets are fully out of the estate for both spouses, so you're never going to have an estate tax on that. But the good part about it is the surviving spouse gets all of the income from the bypass trust, and they can access as much of the bypass trust principal as they need for what's called your health, education, maintenance, and support, which is basically maintaining your current lifestyle. So if you set up with your spouse what's called a marital split or a bypass trust, that's one way that you can anticipate that you might be impacted by the estate tax, even though you're not at that level yet. Another thing that I see people do is, even if they don't have that type of trust set up, if one spouse passes away, there is a way that you can do what's called electing portability, and that is filing a separate return upon the first person's passing that allows you to save the deceased spouse's exemption and tack it onto your exemption, the survivor's exemption, when they pass away, because we don't know what year you're going to pass away in. So for example, I had a client just this year that the mother passed away. Their estate was close to the exemption amount. They didn't have one of those types of split trusts, but we were able to elect portability, file a return that allowed dad to save. It was an extra $6 million he's going to get. So for whatever year he passes in, so let's say he passes away and the exemptions drop down to $7 million. Well, now he's got this extra $6 million that he can tack on. So it's one of those things where they can't claw it back either. So, use it or lose it.
So worth your time.
Yeah.
For sure.
Yeah.
Well, I want to thank you for coming, and we can certainly explore more topics, dig deeper at another time. For those of you that don't live in California, we have an estate planning attorney referral website for all 50 states, so feel free to check it out, and because the laws are different, right?
Exactly, yes. It's important to consult. If your primary residence is in another state, it's so important to have an attorney that's licensed in that state. But we got you here in California if you need that.
Well, thank you, Lauren.
Thank you, Denise.
Cheers.
This was fun.
Have a great day.
You too.